The major averages paring back earlier losses today after stronger than expected economic data cast more doubt around the timing of Fed rate cuts. So should investors reset their own expectations and fine-tune their portfolios to match? Let's ask Gabriela Santos of JPMorgan Asset Management. Here once again at Post 9. Nice to see you again.
Nice to see you.
All right. Chair Powell said, OK, March probably not happening. So now the probabilities went way down. Now, we're gaming out when it's really going to happen. What matters most, do you think, for this market?
I think the general message we got in December is what matters most. We're past the rate hikes, and we're now talking about when we start going down the other side of the mountain for rate cuts. And that truly is a better environment for both stocks, bonds, and credit. And I think especially because of the reason why those rate cuts at the moment are set to be coming, which is normalization on the inflation side of the mandate versus an actual concern from the economic growth standpoint. But I think what we're doing now is just fine-tuning expectations of exactly when, exactly how much for this year. And we certainly think it's more of a middle of the year occurrence, and that the Fed will start very gradually cutting rates 25 basis points at a time, maybe only 3 or 4 this year. But the direction of travel is the same.
So what I hear you saying is that cuts are coming. That's the only thing that really matters. Doesn't matter when and how much. The fact of the matter is that the trend has changed.
I think for the market overall, that's correct. But there are certain pockets of the market for which this actually does matter. The actual timing of when we get interest rates to normalize once again.
Okay.
And that's why we do think it's too early for things like small caps as well as regional banks, which are kind of interrelated. Small caps, just because 40% of that debt is floating rate, half of it matures before 2030, and a lot of it is made up of financials and specifically regional banks, which, as we got reminded last week, are still under some pressure from the credit side as well as the net interest margin side.
See, that's interesting because, normally we would say, OK, the market anticipates, what's going to happen 6 to 9 months in advance. So maybe you'd have positioning in advance of that. What you're suggesting is this may be one of those occasions where those spaces of the market don't get rewarded until the Fed actually cuts. Is that fair?
Or even perhaps when we're a bit further along. I think what you see
further along in the
cutting cycle and in the economic cycle.
Okay.
What you normally see for things like that are very economically sensitive is they do tend to bottom before the economy does. But it's when you're already towards the bottom of an economic cycle and about to reaccelerate. And we're not quite there yet. We'll get to it. Eventually, there will be a recession. There will be a recovery. But for right now, we're still late cycle. We're not quite at that moment yet. So we're still looking for later on the moment to be truly much more optimistic about small caps and financials. There
was an interesting note off the trading desk at JPMorgan today, essentially a mea culpa, which they use those words and they say the cautious call we held since the second half of January has proven overly conservative. Are you more positive on the market today than you've been in many months?
I think what was encouraging was the delivery on the earnings front from some of the Magnificent Seven. Most, not all.
Well, that's true.
And that is still a key message here.
Well, so look, in some respects, we're talking about Magnificent Six at this point.
Or
right?
5 or 4 or new sevens. And I think that's where
fair.
That's an evolving discussion.
Okay.
But if you look at an equal weight index, it's still flat for the year, or a small cap, as we were discussing, is actually down for the year. So I think if there was a reason to be more optimistic versus what you were expecting, it was much more on the delivery of the Mag 7. Now, that's in the short term. We think if we stretch out the horizon further the next few months, the next few quarters, we think much more of the optimism and enthusiasm should be in other sectors where you're going from earnings recession to earnings recovery. And that is, we don't think, fully appreciated by the market quite yet.
Is the narrowness of the market of a great concern to you or not?
It's not a great concern if you don't think that you're actually going to get substantial disappointment from the majority of the Magnificent Seven instead of just 1 or 2, and then you would see the whole index being pulled downwards. What we ultimately think is they will deliver pretty good still earnings growth for this year, 20%. But instead, if you're looking for a reason to actually expect more of a return at the index level, then it's really about looking for where the delta is moving the other way from earnings recession to earnings recovery.